Broadcast is
All right. Let's
We
see. Well, what is up, everyone? This is Channing Moore, the owner of Bayou Mortgage, and we are live. We are live here in the Bayou Mortgage studio to go over the 2023 Home Buyer Masterclass. If you are wanting to purchase a home this year, 2023, this is the class for you. And I have the privilege of being joined tonight by my co-host and fellow loan officer, Miss Tori Meadows. What's up, Tori?
Hey, Channing, how's it going?
We're good. We're good. And so glad that you could join me tonight, get the kids wrangled and everything.
Oh, yeah. Happy to be here.
I'm very excited about this. If you wouldn't mind, just make sure you share the video and all that good stuff so we can make sure we reach everyone. So,
Yep. Working on it right now.
But yeah, so we're just going to take a couple of seconds before we jump in, kind of give everybody an opportunity to see the stream and get on and all that great stuff. So if you do jump on live and you are on Facebook and you want to comment or ask a question in the event, we are using a software called StreamYard. So I think you have to click to accept to give them permission so that we can actually see your name and your question when you send it through. So if you're watching and you see this, please remember to do that so that we can actually see who we're talking to and know what question we're answering and all of that fantastic stuff. So again, just going to give it a couple of seconds for Facebook to do its thing. We're live on Facebook. We're live on YouTube. We are live everywhere, I think. I think we're live everywhere. So I've been looking forward to this. What about you, Tori?
I've absolutely been looking forward to this for a couple of weeks now. Excited to let people know more about what they can do this year with home buying and kind of how the process works.
Yeah, I think it's going to be great. I really do. I think it's going to be great. So these are kind of the things what we're going to go through this tonight is the same stuff that we wish we could go through with every client all the time, right? So if you could come and sit with us individually, one-on-one for 2 hours, which no one who has that kind of time these days, right? But if you could, or an hour, these are the things that we would go over with you. These are the things that we would walk you through and explain. It's just that most of the time, the world we live in, people are busy. They can't do this. So that's why these little things like this are going to be great. So, Tori, I'm going to go ahead. I'm excited. I'm going to jump in because I don't want to keep anybody waiting. I know that we have a lot of stuff to jump into this evening. So let's go ahead and jump in to the content for tonight, which is our 2023 Home Buyer Masterclass. So if you're wanting to purchase a home and you're seeing this video on Facebook, you're seeing this video on YouTube, on LinkedIn, or we invited you, however you got it, you're in the right place. We're going to give you the information that you need to purchase a home in 2023. So let's start off by a roadmap. Where are we going tonight? What are we talking about tonight? Why should you stick around to the end? Well, this is where we're going. In just a second, we're going to jump to the next slide. We're going to talk about some things that you need to be prepared for, that you need to be ready for when you're getting started. Some questions you need to be able to answer, some ideas you need to have, and some numbers you need to get, right? So that's what we're going to do. Then we're going to talk about the different factors. There's 3, there's more, but we can kind of boil them down to 3 major categories that determine your home loan approval. There's 3 things we look at, 3 things. Next, we're going to talk about what a loan officer is, what their job is, how they're paid, and what you should expect from them. Because just like on the real estate side of things, your loan officer is also there to be an advocate for you. And look, I'm already jumping into the content. Let me dial it back a little bit. I'm too excited.
Step back a minute, Channing.
Let me take a step back. So we're going to talk about that. We're going to talk about loan programs and guidelines. That's going to be kind of the meat of what we're discussing tonight is what does it take to get a conventional loan? What does it take to get an FHA loan or a USDA or a VA? Then we're going to talk about down payment assistance, because that's probably, Tori, I think, would agree, a huge question we get asked often. And it is, do I need 20% down to buy a home? We're going to talk about that. Then we're going to talk about the real costs of buying a home, the real cost of buying a home. Let me get over here. I see we have a comment. Bo's on. What's up, Bo? Thanks for joining, man. We just talked to you a little bit earlier, so thanks, Bo. Then we're going to talk about the real cost of buying a house. So we're going to talk about your monthly cost, your closing cost, and this is kind of close to the end, we're going to talk about some games that some lenders or some loan officers may play that will try to trick you into thinking you're getting a better deal than you're not, or to try to win your business even when they know that they're costing you more money than they have to. So Tori and I see that all the time. So I want to share that with you guys as well, because as y'all know, at Value Mortgage, we are all about being transparent with the numbers and everything that goes into that, because we want you to have a good deal and we think that everybody can win. So then finally, we're going to discuss the pre-approval process. What goes into the pre-approval process? What steps do you need to take? What should you have ready? Why is it important? Why is this loan officer telling me that I need to do this? Like, all I keep hearing about is get pre-approved, get pre-approved. What the heck? Well, we're going to talk about that too. And then finally, as we promised to those of you who are on our email list and we texted and we called, and we want to give you something tangible. We want to give you your home buying plan, right? So you're going to get all of the information tonight. You're going to understand everything you need to know about this home loan process and buying a house from our perspective, from the lending perspective. But we're going to give you that thing that you can grab a hold of and you say, okay, that is my next step. That's easy to do. I can do that. We're going to give that to you if you stay tuned to the end. So, Tori, you ready?
I'm ready. Let's get started.
All right, let's jump in. So, let's try that again. There we go. Getting started. So, the first question, probably if you're watching this, you've already answered this question, is are you ready? Right? Are you ready to go through the home buying process? Now, what I'm not asking you is, are you ready to qualify? Because you're here tonight, you're watching this through Facebook or YouTube or wherever you are, because you want to know if you can be ready. But what I'm asking you is, are you ready to go through the process to learn more, right? Is buying a house something that you're serious about? Or is this more a casual, like, oh, that would be nice, maybe, but? Because just like anything in life, when it comes to goals, there are difficulties that you have to get through in order to get what you want. And home buying is no different. There's negotiating with sellers. There's getting your documents in order. There's all these different things that we're going to talk about. So you got to get your mind right, and you got to be ready to go through the process. Number two, really, really, really important. Number two, what are your goals? What are your home buying goals? Are you early 20s, 30s, 40s? Are you looking to buy a starter home? Are you looking to buy your forever home? Are you looking to buy maybe a 2 to 4 unit property and you're going to live in one side and rent out the others for income? We call that rent hacking, right? What are your goals when it comes to purchasing a home? What are your goals when it comes to 2023? When December 31st rolls around, 2023, and it comes to your housing, where do you want to be? And then two of the biggest, most important questions that are going to kind of drive the direction that you go after you watch this class. Number one, what's your budget? What's your home buying budget? And I don't mean necessarily like what price house do you want to buy? Like, do you want to buy a $400,000 house, a $200,000 house, a $150,000 house? Drill down on what your monthly budget is. And Tori, would you say that that's really important and also something that people tend to not be prepared for?
Absolutely. I mean, and it can go either way. It's not always just someone underestimates how much their monthly payment would be on a certain price house. Sometimes they even overestimate it. They think that it's going to be way more expensive than it actually ends up being. So really getting a monthly payment in mind instead of a set purchase price is pretty important.
Right.
And then we can kind of work on it from there on whether we go up or down or which way we can go.
That's exactly right. So determining that monthly budget is key. Just like when you buy a car, just like when you buy anything expensive, although this is nothing like buying a car in the grand scheme of things. It's really important to know where you're comfortable at and to kind of have that firm, like this is the max that I can do, and here's where I would like to be, because you just want to be prepared. I mean, we've all gone car shopping, right? Again, I'm relating it to cars, but we've all gone car shopping and we walk into the dealership and say, I'm not spending any more than 20 or 30,000 or 40,000 or whatever the number is. And then the salesman shows you the car and it's got the full moon roof and the leather seats and the sports package and whatever it is, maybe it's a lifted truck, whatever it is. And you're like, I think I could probably spend 45, like, I think that's feeling more like what I'm about. That represents me better than the base model. And so all I'm saying is, you want to have a kind of a range in your budget so that if you find a house, maybe you didn't think you could find a house with a pool in this price range and it's $25,000 more, you want to be prepared for that. But again, the other important question, and this one's really, really important in determining when you should get started, is when do you want to close, right? Because if you don't want to buy a house, maybe you're locked into a lease and you can't buy until November or October. Well, unless you have credit issues or something going on that you want a professional to take a look at, you probably don't want to be applying for a mortgage that you're not going to get for another 9 to 10 months, right? Because the lender's just going to have to pull your credit again. On the flip side, if you're less than 3 months out, then we got to get on it, right? Like, we need to get the ball rolling because this whole thing is going to go a lot faster than you think it will. And you need to get pre-approved. You need to get your numbers so that you know what you're looking at. So that's getting started. Hopefully we can move through the other ones faster, or we're going to be here all night.
All night long.
Which, hey, I'm good with, but y'all are probably not. So, all right. So let's talk about the first thing, right? We did our roadmap. What determines your options? What determines what you can purchase? What you can get money lended to you for? What's the bank going to give you? How do they determine that? Well, we look at 3 things: your credit, which you guys probably all know, your income, probably also know, and then your assets. We call that CIA, but not the people that are listening to your phone conversations when you don't know about it. No, we're talking about credit, income, and assets. We're talking about where is your credit, what is your income, what is your assets. Now, a lot of you may think that credit is the most important piece, but it's not. It's important. It's part of the deal, but your income is the most important piece of what the lender is looking at, because you have to have what's called the ability to repay the loan. So if you can't repay the loan, it doesn't matter if you have $500,000 sitting in your checking account. If you got no job and no verifiable income, your options and the pool of options that you have available to you when it comes to financing a home are much, much smaller. So let's jump in and let's talk about how your credit affects your approval. So when it comes to credit, you have a credit score, you have credit history, which just basically tells the lender, here's how they've paid their bills over however long, the last 10 years, or if it's not that long, however long you've been borrowing money. And then you have your credit usage, which is how are you using your credit? If you have a $10,000 credit card, is there a $9,000 balance? If you have 4 credit cards, are they all maxed out? Do they all have late payments? All of these things go into how your credit, go into your mortgage approval. And so your credit score is a big one. Your credit history is a big one, how well you pay your bills. And then your credit usage is a big one. Now, don't misunderstand that to mean that if you've had prior issues, or you've had past mistakes, or you've had past late payments, or you've got some credit card balances, that we're saying that you can't buy a house, because that's not true either. Right? I mean, we help people all the time that have had all of those mistakes. I mean, we help people all the time that have maxed out credit cards. We help people all the time that have had late payments. It's about how often and how much and where your score is. And so when we jump into the portion of this class where we start talking about the loan programs, you'll be able to see what those minimum score requirements are, which many of you probably already know. for those loan programs. But what you need to know is that it's not just your score that's driving this train, it's also your history and your usage. And so if you're currently past due on a car loan, I'm not talking about charged off or a collection, I'm talking about your 60 days past due, your 30 days past due, then you're going to have to get those types of things caught up before the bank's going to give you more money. Collection's a whole different story, especially when we go into FHA. But just understand that these are some of the factors that determine your approval. Your credit is a big one. Now, the next question we get, right, Tori, is how much do I need to make to buy a house? Right?
Yeah, and that's the complicated one, right? Because there's no set amount that you actually have to make. There's no minimum amount. It's all on a case by case basis. I mean, there's an amount we'd like to see, but it's all really personalized to each
That's
borrower.
Right. That's right. Lenders use something, and we're going to go on the next slide and talk about this a bit, but lenders use something called debt to income ratio. And your debt to income ratio is simply your gross monthly income and your monthly bills compiled into a ratio. And we'll show you how that formula works. It's very simple in just a second. But like Tori said, there is no minimum income limit. But because of the debt to income ratio, the market that you live in could basically set a minimum income limit, right? So if you live in a small town in Louisiana, I'm drawing a blank on one to name, and you can buy a house for $100,000, then it's okay if you make less money than if you're trying to buy in the middle of New Orleans or Baton Rouge or somewhere where there's a lot of population and the prices of the homes are really high. Then you have to be able to make a good bit of money to afford those, to be able to buy a $400,000 house. And what determines whether or not you can do that is your debt to income ratio. And then the other two things that are really important, real quick, your income must be steady and consistent. Now, we have a blog and it gets tons of traffic every month called Can I Buy a House If I Don't Have 2-Year Work History? And we literally get people that reach out to us from all over America, like literally all over America. Because there is a myth that says that if I haven't been at my job for 2 years, I can't purchase a house. And that's not true either. So what lenders are trying to see is they're trying to see consistent income. So if you've started a new job, you're usually okay as long as you've been on that job for at least 6 months. If it's totally new and you've never worked in this field or you had a gap in employment. But if you change jobs, let's say you're a nurse and you went from one hospital to the next, well, you need 30 days on the new job and you're okay. So it's not so much about a 2-year history at the same job, although that certainly makes it a lot easier for your lender. It's about having a 2-year work history in general. Now, the next question might be, well, what if I just graduated college or I just graduated from high school or I was a stay-at-home mom? Well, those are all unique situations. So your college degree, if you're working in that field, would count towards your 2-year work history. It's a little bit fuzzy if it's not related to what you went to school with. And the same would go for high school. If you've only been able to work for 1 year, then the lender's going to take that into consideration. If you were a stay-at-home mom and you're now re-entering the workforce because the kids are old enough or whatever your reason is, typically you will need to be on that job for at least 6 months. These are some new changes that happened during COVID, but they seem to have stuck around with the lenders and these guidelines, is that you typically will need to be on that job for at least 6 months to prove that it's stable and that we can use, so that the lender can use that income. And with everything, there are loan programs, there are exceptions, but we're talking about the main loan programs that most people in America are going to use. We're not talking about non-QM loans or anything like that, because that would be a whole other webinar, a whole other class on some of the crazy things that can be done with those loans. So no minimum income limit, but we do look at debt to income ratio. And it's a simple calculation. If you make $5,000 a month in gross income, and I put $1,250 here, so I just realized my numbers are off. So we'll just say $1,250 a month in debt payments. So what you're going to do is you're going to take, when we say debt payments, we mean anything that's a monthly payment on your credit report, anything like child support or alimony or anything that's court ordered that you have to pay, back taxes or monthly tax payments that you have to pay. Those types of things are going to be included in your monthly obligations. Now, things like your cell phone bill, your car insurance, your utilities, those are not included. So if you had $1,250 a month in monthly debt payments, car notes, child support, whatever, and you make $5,000 in gross income a month, that's $60,000 a year in income. That could be you or you and your spouse combined or whatever the number would be. That would give you a 25% debt to income ratio. Now, let's say that doesn't include your mortgage payment. Well, in that specific scenario, you would have about $1,200 a month that you could spend on a mortgage. That would put you around 50% debt to income ratio. And that's generally the cap for most loan programs except USDA. So some of you may not have that much. Some of you may have more. Some of you may make more. But it's a fairly simple calculation of your monthly debts divided into your gross monthly income. That is what your debt to income ratio is. So hopefully that helps you understand it, because I know we get that question a lot too. Like, what does my DTI have to do with me buying this house, right? And that's kind of how it breaks down.
Yeah. Hey, Channing, I think we're having a little bit of a technical difficulty on Facebook side. Not pulling up the live stream anymore over there.
Uh-oh. On the group?
In the Facebook group, yeah, and on your page.
I can see it now on my page. I'm looking at it.
Okay, I got you. Wasn't
I don't have my audio on, so I don't know if like you can hear the audio.
Right. Yeah. You're so you're good there, just in the Facebook group itself.
Maybe try just sharing it in there, because I don't know what else I could do.
Yeah, no big deal. I'll get that all fixed up.
And then just drop a comment in there, like they can go to my profile and watch it too if they can't.
All right. Yep.
Good old technology, right?
Gotta love it. Yep. Let me see here. You can continue on while I try.
All right. So we're going to go on to the next slide. And for those of you that watch this later, this is being recorded, I hope. So if it's something that you didn't catch, we will send a link out to you if you request it, if you weren't able to technical difficulties or whatever. So, okay, let's move to the next one. So how much will I need to put down? Now, you already see the answer because I didn't do the fancy animations on this one. But that's a big common misconception in lending is I need to have 20% down. I need to have 10% down. I need to have some type of down payment. I just see Rodney. Rodney, what's up, man? Hey, how are you? Thanks for joining. Looks like you're coming in from YouTube, man. I appreciate that. I appreciate you joining. How much will I need to put down? So a down payment is not always required, but it is better. And so you don't always need a down payment. For instance, if you're a veteran that qualifies for a VA loan, which we're going to talk about in a little bit, you don't need a down payment, right? It's a no down payment program. It's the best loan program in America. And I don't care if you've heard otherwise. No PMI, no down payment. It's the only loan program that someone's ever earned. Great program. If you want to buy in one of these rural areas in Louisiana, and their definition of rural is very broad, basically anything outside of your top 15 cities, suburbs, that can be zero down. And then, as we're going to talk about, there's also down payment assistance. So a down payment is not always required when it comes to purchasing a home. But typically speaking, you cannot have poor credit and get a no down payment loan. And really the only exception to that is the VA loan, because it doesn't have a credit score requirement. So a down payment's not always required, but you can either go from 0 to at most 3.5% with FHA is going to be the most you would technically be required to put down. Now, there could be other factors that could play into that. You want to buy a house for $240, but your budget's only $220. You'd have to put the other $20 down if we can't get you approved for more than that. But as a general way, 3.5% down is the most you'd ever have to put down. And that's of the purchase price of the home. So what is a down payment? Well, we call down payment skin in the game. You've probably heard that before. It is you telling the lender that I am committed and I am serious about this process. I am serious about buying this house, that I'm going to financially commit to it. So you put your down payment down, and they call that skin in the game. It's a percentage, like I just said, of the purchase price of the home. So you put down, if you were putting down 3% and you were buying a $200,000 house, that's a $6,000 down payment. If you're buying a $100,000 house, that's a $3,000 down payment. So I had to do math that was easy to do in the head, right? Can't be looking bad on the stream. So, but it's about the opportunities that you have for the different loan programs. And part of that is going to be determined by whether or not you have a down payment. And it's just because it restricts your options to less programs if you don't have one. So really important, really important. Where can your down payment come from? Your down payment can come from sourced funds, from gift funds, and from grant funds. Cash is not, and probably never will be, an acceptable form of down payment. So if you've been storing your Benjamins under your mattress for the last 10 years and you're ready to put that $40,000 down payment down of mattress money, I have bad news. Your money has to be sourced. It has to come from, and look, this isn't our rule. You can thank Pablo Escobar and whoever else you want to thank, but the government has come out with anti-money laundering practices because many people were using cash to purchase real estate, cash that was dirty, and then they were washing that cash with their real estate purchases. So the government said, we're going to stop that. We have all these different practices. It's why you can't go deposit, if you deposit like $9,000, $10,000 at the bank, they have to fill out a whole form because they are on the lookout for people trying to wash dirty cash, and they need to know where the money came from. And so the only way to do that is to have it sourced. Well, Channing, what do you mean by sourced? It has to have been seasoned in your bank for at least 60 days. Now, this does not include things like direct deposit or payroll. That can be proven, right? Because that can be sourced. But if you just slapped 20 grand cash in your bank and that 20 grand came from 5 years of you saving up, selling lemonade on the weekends in front of your house, whatever you did, that money's not going to be able to be used. So you have to have sourceable funds, and sourceable funds means we know exactly, paper trail, where the money came from. It's been in your bank for 60 days or it's not going to be used. Number two, the gift funds. A lot of people don't realize this, but gift funds are a heavy, I don't even think that's the right word. They're used a lot, right? A lot of people get gift funds. It's not a shame thing. Like, a lot of people do it. And I see Rodney is asking on the chat, can I use my pension loan for a down payment? Yes, as long as the money can be sourced through your retirement account, you can borrow from your retirement or from your pension if it's allowed. You'd have to reach out to your plan provider because we're not financial advisors. But yes, we have had clients use their retirement funds for a down payment. And there are strategies that you can put in place to reduce the tax burden on some of these plans or the penalties. So definitely would recommend talking to your plan provider and a financial advisor if you have one. And if you have any further questions, feel free to shoot us a DM and I can tell you what some of our other clients have done. So lastly would be grant funds. These are your down payment assistance funds. So these are, I went down and I filed for NACA, which is a program that takes a really long time to close. Or I went down and I'm drawing CAFA funds, like CAFA or Louisiana Housing Commission has 27 different grant programs, right? And as long as you work with one of their lenders, which full disclosure, we are not one, then you can get their grant funds, right? Or like we have our own down payment assistance programs, and those would be considered grant funds as well. So all of those can work, but cash is not an acceptable form of down payment. So if you got cash and you want to buy a house, go deposit it. Go put it in your bank and get it seasoned. Because if you don't, you're going to run into issues when you're ready to buy. Anything you want to add to that?
Nope, that's about it. I was going to touch on the no down payment programs, but I think you just about covered it.
Did we get the live stream issue sorted or no?
I think so. If you said you could see it on your side, I still can't see it on my end. So okay. I'm not sure. It's showing nothing from Facebook. So I don't know what's going on there.
Well, I feel bad about that. Did you post in the group and just let them know?
Yeah.
Or the event, rather?
Yeah.
Okay. So hopefully. All right, moving on. This is really important. Tori, can I put you on the spot? Do you want to talk about this a little bit?
Oh, absolutely.
All
Absolutely.
right. All right. So I'll put you on the spot and let you talk for a few minutes, and I'll take a little break here.
All right. Yep. Just letting the people of Facebook know that we are having some technical difficulties. Gotta love Facebook. Gonna drop link to StreamYard here.
So the next thing is that we're talking about is what's a loan officer? What does a loan officer do? Who are they? Why are they involved in your transaction? We're loan officers and mortgage brokers. They can be the same. So like, what do we do? Like, why are we here? Why are we talking to you? And why do you have to talk to us if you want money? So Tori, you want to kind of explain a little bit about that?
Yeah, absolutely. Absolutely. So we are here, as you'll see on the screen, took the words out of my mouth, to advocate for you as a client. We're going to help you get through the underwriting process. That's going to be the biggest thing that is going to stop you or allow you to purchase a home, is going to be the underwriting process, which I'm sure we'll go more into depth on. I'd hate to sit and explain to you the underwriting process for 30 minutes, and we'll do that later on. But basically, you have somebody who's going to tell you yes or no, you can't buy a house, and we're going to help guide you through that. We're educated on all the different loan programs, what they offer, how they work, how you can qualify for it, and also kind of how to get yourself in a position to qualify for them. So we're there to educate you on that end as well. We'll be able to look at a loan application and let you know how good it looks, if there's anything that needs to be fixed, if there's any clarification on it, we'll go through that with you. We'll also explain exactly what you can expect from your mortgage payment and how your loan is set up. We'll help you after the loan closes as well with any issues you need. If you get something in the mail you don't understand, we're here to help you out with that. We're kind of just guiding you through and then beyond the process of being able to purchase a home.
Yeah, I agree. I can see now that part of the reason with the stream was it wasn't set to public. So now you can keep going though, if you want to cover the rest of those. And
Absolutely. Absolutely. The next part is that we're going to also make sure that we're not just throwing you in blind. You'll hear of some big lenders that will just take some information, say, yep, you're good, you're pre-approved, and then everything falls apart. It turns out that they didn't know everything they needed to know because they didn't review everything that needed to be reviewed. That kind of goes back to that we know what to expect from the underwriting process. So we know what to look at when it comes to your documents that we're going to get from you whenever you are going through the pre-approval process. We'll make sure that your pay stub matches up with what we have on file for your income. We're going to make sure that, your W-2 matches up with what your pay stub does, and it matches up with your history, that we have that full 2-year income. We'll look through your bank statements to make sure all of that looks good. We are verifying that your info that you gave us is correct, and it's going to save you a ton of headache later on in the process that could potentially come up if you don't have somebody doing that for you.
I don't think that it can be stated enough how much our job is to advocate for you.
100%.
So you and I, you've been doing, how long? You 2 years or a year and a half? You've been with me
for 2 years. I've been with you. It'll be 3 years this year, but I've been originally for 2 years now.
Time flies when you're having fun.
For sure.
So sometimes when we talk to clients, you can kind of feel that pushback of like, and I know this because in a former past life, I worked in the car business, which is why I'm full of car business references. The client would never want to give you what they wanted to spend per month because they're worried you're going to use that against them, later in the finance office. Well, you said you could spend $450, so it's $467. It's not that much more, right? So, but that's not at all how any reputable loan officer is going to work with you. Our job is to understand your budget, and that's the point there. Understand your goals and what your budget is, so that we can appropriately prepare you for whether or not your budget will realistically get you into the house that you want to get into. Because if you say that you have $1,000 a month budget, but you want to buy a $250,000 house, one of those things has to change, right? either the budget has to come up, or if the budget absolutely can't come up because of debt to income or whatever reason, then the purchase price is going to have to come down to meet those expectations. And so it really is our job to advocate for you. Now, I can't speak for all loan officers, but certainly the ones we associate ourselves with, most of the ones locally, most of the ones that I know, all across the country, they're not here to screw you over. Now, I can't say the same thing for the online loan officer or the guy that answers the phone that was working at the Taco Bell. And nothing wrong with working at Taco Bell, but 6 months ago, right? I can't say that about them because those companies teach their people to hard sell you. And their entire purpose and goal in their role is to get you on the phone, sell you a dream, and collect $500 from you up front, and then push you on down the line. And so you really, really want to be careful when it comes to who you're working with. And like Tori said, we're reviewing your loan application. We're validating all your documents. We're finding loan programs for you. But those are all things that I would hope any decent loan officer would do for you. If you want to work with a good loan officer, then, and this is kind of how you know, how are they presenting things to you? Are they giving you multiple options if multiple options exist? Are they explaining, hey, you can go with this rate and it'll have less in closing costs, or you can go with this rate and it will have more in closing costs, but you'll save on your monthly payment. Here's what FHA looks like for you. Here's what conventional, or here's what FHA and USDA looks like for you. Or here's VA and conventional, and VA would win all the time, right? Are they giving you the choice, the power to choose? And is there education behind it so that you're not looking at a paper and going, what's that mean again? Right? So who you work with matters. Secondly, are they communicating with you? Right? Are they providing prompt communication? If you have to log in to a chat bot to talk to your loan officer, you're probably working with the wrong company if you're a first-time home buyer. Now, listen, if you have an 800 credit score and you've been at your job for 10 years and you have 20% down and you've never missed a payment in your entire life, and this is the 10th home that you're purchasing, by all means, go use whatever lender you want to use that's going to give you the best rate, because there is no detail in that loan. It's literally such an easy program to do that nearly anyone can do it. So absolutely, whoever gives you the best rate, go get it, right? If that's all that matters to you. But if that's not your situation and you're a first-time home buyer and you have a lot of questions, why on earth would we work with a chat bot? Like, hello, Mr. James, this is your client Channing, right? Can I please speak with you? Oh, I'm sorry, I no longer have availability for this week. How about 2 weeks from now? What? I have a question now. I'm trying to put an offer in now. Like, that's not going to help me, right? And you can tell I get a little passionate about this. But if you're a first-time home buyer, please don't discredit or discount working with someone that you can pick up the phone and talk to, right? Nobody goes into offices anymore, so we're not going to use that. But you got to be able to talk to them. You got to be able to ask questions, and they've got to be knowledgeable enough to answer your questions. And if they're not, big red flag.
Well, if you can't get them on the phone in a prompt manner, who's to say that they're going to handle the rest of your loan in a prompt manner anyway, which I know is something that we're going to talk about in a second about closing your loan on time. That's something you have to be able to rely on, as somebody who can get on the phone and explain things to you and will be quick to do things like that, so that you know that they're doing it on the other end too. They're handling your stuff fast enough.
Right. If your loan officer isn't absolutely bugging the crap out of you to get you whatever it is that they need, then you may be working with the wrong person, because closing your loan on time is critically important. And the faster you can close, the more attractive your offer is to a seller. Usually the market's cooled a little bit, so it's not as wild and crazy as it was a year or two ago. But closing your loan on time is also a two-way street. And so if they're not bugging you like, hey, remember I told you I need this pay stub. Hey, remember I told you your driver's license came in fuzzy, or whatever it is. Like, if they're not doing that, if you're only hearing from them once every week or once every couple of weeks, and you're already under contract and you're trying to close, you got to question that. They should be on you and then you have to be on it, right? And that's the formula for success in closing quickly is everybody's on the ball, everybody's giving everybody what they need and getting what they need, and that's getting submitted. Because the deal is in underwriting, and I know I'm kind of going on here, but in underwriting, the underwriter sometimes, depending on the lender, they're not looking at your documents individually. So if you send me the pay stub, they're not going, okay, got the pay stub, that looks good, let's go on to the bank statement. No, they're not going to look at anything until they have everything. And a lot of lenders are like that, because it's just too inefficient for them to sit there and piecemeal and read and go through conditions one by one. So getting everything, all of it, everything quickly, very important. All right. So let's talk about something juicy, right? How much do we get paid? So I may not tell you the exact amount, but I'm going to explain to you how this works, because I think it's important for transparency's sake for you to understand how this process works, so that future clients who watch this, because we're going to send this out everywhere, can understand just this clip of how it works. Tori, do you get a salary?
Nope.
Do you get paid for showing up today?
Not a cent.
Right. And so most people may understand that. Most people kind of understand that about their real estate agent when they're working with them, like, hey, they're working on commission. And this is not, oh, Tori's gone. So this is not like a woe is me, feel bad for the loan officer speech. But what I want you as the client to know, as the first time home buyer to know, is the loan officer is paid commission by either the lender that they work for or the lender that they send the loan to. And that money is paid to them by that lender. So what that means for you as the buyer is that they should be invested, right? Because we don't make a penny until the loan closes and funds. And then we have to wait 6 months to, before we can really be sure. Because if you default or sell the home or do anything like that within 6 months, then we could be charged. We would be charged back for whatever we earned. So I say that to say this. You've already heard me say that we're your advocate, but we're invested. If things go difficult on the loan because of some unforeseen thing, or maybe we didn't get the full story, or whatever the case is, the loan officer is invested in doing whatever they can to make sure that the loan closes, because they don't get paid if it doesn't close. On the flip side to that, what I wish that I could tell everyone, and I guess I can because I'm live and y'all are watching me, is that if your loan officer answers their phone for you at 8:00 at night to get you a loan estimate, to show you how much it would cost you to buy this house that you just looked at when you got off of work, if your loan officer answers your phone call on Saturday morning in between soccer practice and choir practice or whatever it is that they're doing, to get you a loan estimate, to answer your questions, to show you, and then your realtor or your father-in-law or your best friend says, hey, why don't you go check out this other lender that I know? At least give them, if they've been doing their job, at least give them the courtesy of competing for your business if you were to get a better offer. I would never tell anyone like, hey, take a bad deal, right? I would never tell anybody that. Like, yeah, they're way better than us, but we're so cool, like you should use us instead, even though I cost you, which doesn't really ever happen. But if I cost you $100 or $200 more a month, like, hey, go take that deal. Like, please go take that deal. We'd be the first to tell you that. Like, I can't touch it. I can't beat it. Again, we're brokers, so that doesn't happen that often. But when it does, we would be the first to say that. All we want, as people who don't get paid unless it closes, who answer your phone calls at night and on the weekends, is if you do talk to another loan officer and they are promising you something, to give us a chance to compete. That's all we want, right? Like, just give us a chance. Like, we'll see what we can do. Now, you'll say, well, why wouldn't you just give me that deal up front? I know, I've heard it. And when we go into the closing costs here in a minute, and I talk to you about the games lenders play, the reason is that the government makes it very difficult for us to discount loans because they don't want to impact, let's say, a minority or something in an adverse way. So in order to make that fair, we are pretty much required to have something in writing if we want to cover our butts, we're pretty much required to have something in writing to say X lender offered them this rate and term. That's why we reduced our cost on the loan so that they could get X rate and term. Because if you did that for only one subset of the population and you didn't do that for another one, and that was provable in an audit trail, I'm not your loan officer anymore because I'm in jail or I've been fined or, whatever the case may be. So your loan officer is paid commission. That was a long rant, but I feel like it was necessary. And all we want is a chance to compete. If you get referred to another loan officer, don't just ghost the one that's been answering your phone calls on Saturday morning and weeknights instead of spending time with their own family. I just feel like that's common courtesy, common decency, and everyone would expect that. So, end rant, moving on. Let's talk about, and I think this is kind of clear, the most costly myth that you have to avoid when you're purchasing a house. Sorry. It's this. It's simple. Believing that all lenders are the same. You would not believe the amount of conversations that I've had. Tori, you've had them where they're like, well, what's the big deal? I mean, y'all are all the same anyways, right? Like every lender is the same anyways. And guys, that's not true. So there are multiple different structures in mortgage lending. You have retail lenders, you have credit unions, you have banks, you have mortgage brokers, which is what we are. They all have their pros and cons, but some are by nature more expensive than others. And generally speaking, the bigger the lender, the more levels of management that exist, the more expensive it's going to be for you to use them. And so to offset that, those type of lenders will sell you on the fact that they have the best service in the world, right? But that's kind of a false dichotomy, because what that says is if I have the best, then someone else can't have great service either. And so I grew up in that platform in this business. I've primarily worked in that platform until 3 years ago when I started buying mortgage, because I felt like being a mortgage broker, which basically means I shop dozens of lenders for you. Tori's able to shop dozens of lenders for you.
All of them.
Gives us the best advantage because we can provide, because it's just real people. We're not sitting off in a call center in Michigan. It gives us the opportunity to shop the loan for you, provide you with those low rates because we're wholesale, but still give you that great, fantastic service that you'd get at a Chick-fil-A or a Buc-ee's, right? And so, you walk into Buc-ee's and, I mean, the place is popping. So mortgage brokers can do that. Mortgage brokers can offer you the service with the low rate. So please don't make the mistake of thinking all lenders are the same. And the number one action that you should take away from that is that if you haven't shopped with a broker, or if you've only shopped with one lender and that lender can't shop multiple lenders, then find someone who can so that you can compare that quote. And that is especially important if you are on the lower end of the credit spectrum. If you're under a 700 and you and you didn't shop your lender, you need to, because most of these lenders, when it comes, the lower credit people, the veterans and the FHA deals pay for everything so that they can discount the conventional loans. We don't have that model. Our compensation is about half of what our retail competitors are, and we've just lowered it even more coming into 2023. And we charge the same across the board, conventional, FHA, VA. So not all lenders are the same. Please shop. The statistic's crazy too. It's like, I don't want to even throw the number out because I'm not sure, but it was over 70% of people never even shop more than one lender.
You're doing yourself a disservice if you don't shop. And that's coming for someone. I would love if you would just come to me and take my quote and go with it, because I know it's a great quote. I know I'm going to give you the best thing I can get, but you're doing yourself a disservice if you don't try. At least try.
All right. We are already almost an hour into this thing and we still got a long ways to go. So so when it comes to choosing the right lender, I'm going to go through this, guys. You want to focus on communication, rate, fee, and options. Why is communication up number one over rate and fee? Because if you can't talk to them, you can't get the loan closed. You can't get your questions answered. And your loan's not going to close because it's going to take longer. And then the seller's going to pull out. And there's just a lot of drama that happens when you can't get your lender on the phone. So communication is number one, but right behind that is rate and fee, right? What are their rates? What are their fees? And then finally, what are their options, right? Do they have any special programs? Do they have multiple options available to me? If you go down to the big bank around the corner that starts with a C, they got conventional loans and that's it. And so if you're one of their customers, yeah, they're going to market mortgages to you, but it's going to be one option. It's going to be one loan, conventional, and that's it. So picking the right lender involves getting good communication, good rate and fee, and good options. Now, here's the meat and potatoes of this. Some of this stuff you guys may already know. Tori, you want to talk about conventional loans for a second?
Yep, I got it.
All
Conventional loans is almost exactly what it sounds like. Conventional is a standard loan, and it's going to be one that you've probably heard of a lot. You probably hear about it before you hear about any of the other loans. You do need a 620 credit score and above for these. But I will say that most of the time we're going to be looking at a 680 or above for these. The lower credit, a little bit harder to get an approval on it. And we can't really work with what's called a manual underwrite with conventional loans. So a 680 and above is really what we're going to be looking for on these, but we can do them with a 620 in certain circumstances.
Typically, you would need to have like 20% down so you don't have to get PMI.
Yeah.
And you need to have like nothing past due. So it's technically possible at a 620, but you really need to get over 700.
Right. Which going with the 20% down, that brings us to our next. That's a huge misconception that I hear from people all the time is that they need a 20% down payment. Not true. First time home buyer, 3% is all you need for this. You will have PMI. You wouldn't have it if you did put 20% down, but that's not necessarily a bad thing. It makes you where you don't have to save up that lump sum of money just to get started. So all you have to do is 3% for a first time home buyer. If you're not a first time home buyer, it goes up a little bit. We can look at it 5% there. You can get up to 3% of your closing costs paid by the sellers. These are called seller concessions. That's 3% of the purchase price. So just depending on how much.
One important thing I want to mention there, that's if you put the minimum down. If you put 10 or 15 or 20% down, you can get 6% seller concessions.
Right.
Most people that are getting seller concessions aren't doing that. So
yeah, true. So then the next part, it's going to be the max loan amount is based on your county parish loan limits. That means that it depends on where you are at for how much you can get of the loan. One area, let's say California, they're going to have way higher limits than we have here. Their cost of living is higher. Generally, they make more money over there. They have higher loan limits. Their housing market is just higher. Us here in Louisiana, not quite as inflated. So our maximum loan amounts are going to be a little bit lower. It just depends on where you're at. That tells you how much you can purchase with a conventional loan.
Yeah, I think our loan limits right now, these change every year. I think they're 726, 200. So they're getting up there on conventional, but in California, it'd be like 1.5 million. So
right. And they did go up quite a bit. When was that big jump? Was that the middle of last year that they went up quite a bit?
Yeah, and then they jumped again pretty good this year too. So
yeah. So they are going up steadily. You know, who knows? One day soon we may see that $1 million mark. But right now, that's where it hits at. That doesn't mean that you can't buy a house above that amount. Obviously, just comes with a different loan program.
Right.
And then you can use a conventional loan on your primary residence, which is going to be the house that you live in all the time. That's your thing. Your second home, which is a home that is aside from that you purchase that you have to stay in. Was it 6 months out of the year to be considered a second home?
Something like that. And it kind of needs to be in a vacation destination. They look at that as well.
There has to be a certain amount of miles away from where your primary residence is. And then, of course, investment properties. This is your rental properties, houses that you're looking to buy to rent out to other people, something that's going to make you a stream of income. You're investing in it so that you can let somebody else use it.
Right. And I put the asterisk there because when it comes to second homes and investment properties, you need 20% down, not 3 to 5% down. So the only exception to that would be if you are a child trying to purchase a home for a parent or that is unable to work or doesn't make enough income or is disabled, or if you are a parent trying to purchase a home for a child with the same situation, then you can use what's called the Family Opportunity Mortgage, and it's only 5% down. You don't have to live in the home. You can buy the home for them, and you get regular primary residential interest rates. So a lot of people don't know about that program, but we've actually done one, and I had another one in the works. So.
Yep. But that's the basics of it. That one's going to be, it's not as document heavy because it's for those higher credit score borrowers. And I think appraisals, they still want your house to be in good standing, but they're not quite as picky on cosmetic things either as with like an FHA loan or a USDA loan, which you ideally want your house to be perfect regardless of what you're doing. But, especially after hurricanes and stuff, you would be surprised the amount of people that come to us and say, hey, I have a house, don't necessarily want to do a renovation loan. It's just got a few things that aren't quite perfect. And those houses will qualify for a conventional loan, but they won't qualify for an FHA loan.
You'll often see, if you're looking at a listing, it'll say like only qualifies for conventional or cash. And that's kind of a telltale sign that there is something in the home that needs to be repaired because it won't pass FHA. So.
Right.
All right. So moving on to FHA loans, this is probably the number one loan that we do, and most lenders across the country. FHA is very popular. It's very flexible. FHA loans for the 3.5% down payment only require a credit score of 580. So if you have a 580 or higher and you have 3.5% down, you can purchase a mortgage. You can borrow, not a mortgage. You can get a mortgage to purchase a home with a 580 credit score or higher. Now, it's still subject to underwriting and all of these things. So in this market, it can be tougher if you are under 600 to get a home right now because of the spread on the interest rates. And so most lenders are not wanting to purchase these mortgages with these lower scores. So if the regular rate is middle fives or upper fives or maybe low sixes, you may be 7 if you have a 580 credit score. So it's one of those things where it's like, technically, yes, we can do this and we would help you do this because we believe that owning a home, even if it's a slightly higher rate, is still cheaper than renting if you're prepared for it. But most people, there are things you can do that won't take that long that you could get your credit score up. And so we actually are going to do another one of these. I'm going to do another one of these for folks who have less than perfect credit to teach you what you can do without expensive credit repair, without, expensive services, without sending out 400 dispute letters. What are the practical things that you can do to get your credit? None of it's going to be earth shattering, but you will have the tools you need to get started, and you won't have to spend $600 a month or $300 a month or whatever it is. So FHA is great because it allows 6% in seller concessions. It'd be highly unlikely you'd ever get that much, but 5, 6, 7, 8,000 definitely possible. Definitely see 5 a lot more than the others, but it's going to allow, and all a seller concession is, because I'm not sure we defined that, it's money that when you make an offer on a home, which is why it's important you work with an agent that can negotiate, you can ask the seller to pay for some of your closing costs or all of your closing costs. So that can alleviate the burden off of you, because generally closing costs are 2 to 5% of your purchase price. If you buy a $300,000 house, it's closer to 2. If you buy a $100,000 house, it's closer to 5. So they can actually pay that money for you up to 6% of the purchase price. Again, max loan amount is going to vary by state and parish. In Louisiana right now, I'm going to look it up because I did not.
It's in the 400,000s.
I believe I want to say 487.
Yeah.
472. 472.30 is what the limit is right now for FHA. So you can borrow as much as $472,000 in Louisiana right now. Again, high cost areas, Dallas, California, the Northeast, they're going to be much higher. And then FHA is only for a primary residence. You cannot purchase a home for an investment property. You cannot purchase a home for a vacation or an Airbnb or anything like that. With that being said, you can purchase a property up to 4 units if you're going to live in it for at least 12 months. And if you don't, and you say that you do, that's called mortgage fraud, and they will fine you and potentially bring you to jail. But
we don't partake in that.
but you can buy a duplex or a quadplex. This is called FHA hacking, rent hacking, right?
House hacking.
House hacking. Yeah, I keep.
We'll get there.
Yeah, you're house hacking, right? So you live in one side for a year, you rent out the other 4, which is more than paying for your mortgage payment if you've done the deal properly, and you can do that. That's totally fine. That's not considered an investment because you're actually living there. But FHA is going to be a lot more flexible on everything, except the condition of the home. They're very strict. But when it comes to FHA, they're going to be flexible on your credit. Okay. It's okay if you've had collections. It's okay if you've had past due accounts. Now, you still have to get current past dues caught up. But if you have a loan that charged off, or if you have a collection account, if you've had prior credit issues, if you've had a bankruptcy, there are ways that you can still be financed. No, it doesn't take 10 years ever for any program.
Never.
You can buy a house if you file bankruptcy, regardless of if it's a 13 or a 7. There is a waiting period. Chapter 7 is 2 years. Chapter 13 is 12 months of one-time payments. So you can actually do it while you're still in the process of it if your trustee approves it. And we've got stuff on that. If you have questions about that, you can email me, direct message me. I can send you the guidelines for that. But they are more flexible. They do have a higher DTI limit. All of those different things make FHA loan probably, I'd have to look at the statistics for us. It's our most popular loan, but nationwide, I'm not sure. Probably up there though. They're really important. Okay. You want to talk about, well, I'll do VA and I'll let you do USDA.
My favorite, VA loans.
You want to do VA? You do it. I'll let you do it. I'm very passionate about it, so I'll probably talk too long anyways. So
it's okay. No problem. Feel free to jump in whenever you want to talk about it some more. So VA loans are perfect. We love doing them. We love veterans. Definitely value anybody who has serviced our country in any way, shape, or form. So definitely my favorite loan program. I get really excited whenever I get someone on the phone and they tell me that they are either active military or retired military, anything like that. Super exciting. And they are definitely going to be your best option if you can qualify one. They will save you the most amount of money. Before we get into all that, they do have some pretty flexible guidelines as well. There is no minimum credit score requirement. Generally, we like to say about a 500 and above, but I think we can flex on that a little bit. Most lenders are going to require 500, but you'll talk to some lenders that will tell you a 620. So, and that's not correct.
Yeah. I think all of our lenders right now require a 500 or better. There's a couple of lenders that don't, but man, they are really tough to work with. So we don't do those. But I mean, we can get you to a 500, like
easy.
Yeah.
Yeah, I hear people on the phone all the time that call me and they say, I'm looking into an FHA loan, and we start talking, I'm trying to get some information, just kind of hear about what they need. And I ask them what they do or anything, and they say, oh, I used to be in the military. I get my VA disability, or I am active military. And I bring up an FHA loan and they say, oh, well, I was denied. They told me I couldn't do that because my credit's not a 620. And that's just, it should never be the case. But it's absolutely not the case for us. And it's not what the federal guidelines say. It is a no down payment program. So it's going to save you some money, 100% financing. You don't have to put any money down. You can get up to 4% seller concessions on this one, which is kind of what we talked about with conventional and FHA. 4% of the purchase price, the seller can pay some of your closing costs for you. Whenever you do that, I mean, we even have people who come with nothing to the closing table whenever that happens. It's fantastic, really. Who knew that you could buy a house and have absolutely no money brought to the table with it? You can buy for a 1 to 4 unit family or 1 to 4 family primary residence. So we're not looking at investment properties on this one either, but you can buy it for a primary residence.
And there's house hack with it, just like FHA. So
yeah, absolutely. You can live in one side, rent out the rest, and basically have it cover your mortgage payment plus some. There's no no PMI, no private mortgage insurance. This is a big one. You'll have this on all FHA loans. You'll have it on USDA loans, and then you'll have it on your conventional loans, unless you put 20% down or pay your 20% in. Basically, what private mortgage insurance is a monthly payment that's on your note that protects the lender. It doesn't actually do much protecting for you. It doesn't do anything for you, but it protects them in case you default. And just depends on how much your loan amount is and the lender for how much it is per month. But if you're having a larger loan amount, this could save you a ton per month on your note. So there's no private mortgage insurance and no down payment requirement. You're saving a bunch right there. But it is only for people who are active duty, their family members or surviving spouses that are eligible for it, and then veterans as well.
Yep. It's a great loan program. It follows the same guidelines on appraisals as FHA does. I know one of the big pushbacks that a lot of clients have, I've seen, listing agents or others say, like, it's not a great loan, the appraisals suck, like all this stuff. It follows the same guidelines as FHA, right? For the most part. And it's the only loan program where you actually have the opportunity to contest the appraisal easily. So if you have an appraisal and it comes in low, but the comps say it's not, you're going to get notice of Tidewater. They're going to tell you you're supposed to get notice of Tidewater. We had one where we never got it.
Right.
They're going to tell you it's coming in low, and then you can provide 3 comps and say, hey, look, this is why I disagree with your decision. And what's really cool about that is it's not just up to the appraiser. So no offense to the appraiser, but it actually goes through a VA review process. And so even if you don't get everything, the VA very rarely comes back and says, yeah, we 100% agree with this appraiser's assessment. So the last 2 we did that with, and we don't see them often, but at one point last year when the market was starting to go down, we started seeing some lower appraisals because the market hadn't adjusted yet. We got over halfway there, right? So really cool feature with VA loans. And it's one of those loan programs that people don't know enough about. Loan officers don't know enough about. I've heard of people trying to get a VA loan, with somebody who doesn't know what they're doing. They're like, oh, you can only buy a $36,000 house because that's all your eligibility shows. And it's like, no, that's not really how it works. That's not really how it works.
And not what that means.
And so VA loans actually don't have a loan limit either. So you can have VA jumbo loans. You can buy $1 million properties with your VA loan. Like there's no limit. So I would just say, if you are a veteran and you're watching this live, or you catch this on a recording or on Facebook, and you've been told that you should consider conventional or something else and not use your VA loan, I'd love to talk to you. I'd love to share with you why that's trash advice and why you should stick with the VA. So I think we covered what we can there. So let's jump in. Underrated, very underrated. Another loan program, USDA loans. Not a lot of lenders use or utilize these programs. Louisiana is a very unique state because we have a lot of eligibility for the USDA loan program. You live somewhere like Houston, none of their suburbs qualify unless you get real far out because there's just so many people living there. So the USDA loan is a 100% financed loan, which means you do not need a down payment. What it does not mean is that you don't have closing costs. But again, I missed it and I didn't put it on here. Just like FHA, you can get up to 6% in seller paid concessions to cover your closing costs. So 100% financing, you must purchase in an eligible area, but man, they are very flexible on what they consider rural. So I think it's anything with 25,000 or less in population. So for my Louisiana people watching this, which I believe would be most of you, if it's not inside of Lake Charles, Lafayette, Baton Rouge, New Orleans, Shreveport, Bossier, or Alexandria city limits, it pretty much or Monroe, it pretty much qualifies. So if it's in any of those suburbs, right? Zachary and Baton Rouge, I don't have time to list all the suburbs. You guys know what I mean, right? So all the suburbs, all of the suburbs qualify. The only suburb that I'm aware of in the entire state of Louisiana, I guess if you consider West Monroe a suburb, then West Monroe wouldn't qualify, parts of it, and then Metairie, and that's it. All of the other suburbs are going to have some type of eligibility for USDA. Now, you have to make less than the income limit. Tori, do you know that number off the top of your head? Not sure why I didn't put it here.
103.5, I believe, or 103.3.
Yeah. So if
It's
all
one of
of
those. 103,000 is or less. That's for 1 to 4 people. If you have 5 people or more, I believe it bumps up to 136.
That's right.
136.
So if all of the people that work in your house, if you're, you and a spouse and you both work, or maybe you have 3 people, it is household income. But as long as the gross income of everybody working in your house is under the income limit, which we just said is 103 or 136, if you got a bunch of people in your house, got some kids or other people living with you, you're going to meet the income limit for this program. It's a lot higher now than it was when I first started doing loans. And so that makes it a lot easier program to do. Now, it does have a minimum credit score requirement of 580. And I know that says 640, but the reason it says 640 is it's almost impossible right now to do a 580 on USDA. The rates are just not where we need them to be for this to be a viable program for somebody under 620. But if you have a 640 or higher, you're going to get the automated approval. Well, you could get the automated approval. Let me step back because you still have to go through the process, right? That's going to mean you don't have to put down any type of reserves or anything like that. So it's truly a very low cost, 100% finance program. If you're under 640 or you don't get an automated approval, then you're going to have reserves, and that's 3 months of your mortgage payment. So if your mortgage payment's $1,200 a month, that's $3,600 a month you have in the bank. You have to have in the bank. So it gets a little tricky there. Again, with USDA, it is a primary residence only, and I don't think you can house hack with USDA. I think it has to be pretty much a solo dwelling, single family dwelling. Now, just like FHA and VA, you can buy mobile homes, you can buy condos if they qualify, townhomes, single family homes, that kind of stuff. The other thing about USDA, though, is it has reduced PMI. So the PMI is lower on USDA than any other loan typically, unless it's a conventional loan with a high down payment. And so what that means is you're going to spend less every month, and they don't call it PMI. It's a guarantee fee is what they call it. But you're going to spend less on that every month than you would on a different loan program. The drawback is that you have a lower debt to income limit on USDA. So if you're someone that's carrying a lot of debt and you don't make a ton of money, which you can't because USDA doesn't, you wouldn't qualify anyways, then you need to be cautious with USDA because their debt to income is capped at like 43%. There are some exceptions that can get you to 45, but 41 to 43 is where you really need to be to qualify for the loan. So with that being said, there are some pros, there are some cons to USDA. We love doing them for the people that fit the box, but you need to fit the box in order for it to work. And I'm going to jump into down payment assistance. So down payment assistance is simply financial assistance for your down payment. And this can be in the form of a loan or a grant. So you could get a loan, which would be like a second mortgage that's attached to your current mortgage, usually for 10 years. It has its own interest rate, its own payment, but it's all blended together and you pay that every month. Those are the least attractive, in my opinion, forms of down payment assistance. Or you could get a grant. Now, like LHC, most of their grants have a forgiveness period of, I think, 10 years. So what that means is if you use one of their grant programs, you got to have 620 or 640 credit score, low DTI, you got to make less than like 80,000, 60,000 a year, something like that. And you have to live in the house for, it's 5, 7, or 10. They have different ones, right? So if you need to move before that period is up, then you'll be charged for the money you received. So again, they can be forgivable. Most of them are time-based in their forgiveness. We offer a down payment assistance program that is immediately forgivable. It's provided by one of our lenders. It's called the Empower Down Payment Assistance Program. It doesn't have an income limit. It doesn't have any of those factors, and the loan is immediately forgivable like day one. You close on the loan tomorrow when you wake up that next day, it's forgiven, right? And so it's a great program. It does have a higher interest rate because the lender is giving you funds, but it is a great program if you have no shot at saving a down payment or qualifying for any other type of no down payment program. So the pros and cons of down payment assistance, and I pretty much just covered them. It can force you to have to stay in the house longer if you don't have the equity to move. If you have one of the ones that's only forgivable over a certain period of time, it's going to make your payment higher. So you're either going to qualify for less or you're going to spend more, or both. So those are factors to consider. But again, if you're renting and you're paying $1,500, $1,600, $1,200, whatever the number is on rent, you're not building equity with that anyways. So if the numbers work, yes, the interest rate can be higher, but it might still be worth doing. However, what we try to do, especially because of the way how eligible Louisiana is like, man, can we get you USDA? Because if we can get you USDA, it's the best of both worlds. You're not coming up with a down payment, and you're going to have a lower monthly payment and a competitive interest rate. And then if not, okay, well, let's look at Empower, or hey, go take a look at LHC. We don't offer it, but some of our lending partners do, and or CAFA even. We do have lenders that offer CAFA. So there are options, and it comes down to your unique situation. Anytime you start getting into like specialized lending, like down payment assistance or non-QM or even USDA to an extent, it's really about, do you fit into the box? And if you don't fit in that box, okay, let's try this box, right? Every situation is unique and different. So, and I'm going to move quickly because I said an hour and a half and we got 15 minutes. So how much does it actually cost to purchase a home? Well, you have two costs to consider. Number one is your monthly costs. This is going to be your mortgage payment. And number two is your closing costs and your prepaids. This is going to be the check you write at the closing table, or somebody else is writing for you via seller concessions or something like that. So when it comes to your mortgage payment isn't just the amount you're paying back to the bank. Your mortgage payment is that, which is known as your principal and interest. Your principal is the money you borrowed. Your interest is the interest on top of that. Your taxes, these are your property taxes at the end of the year. Your insurance, you have two different types of insurance potentially. Your home insurance, three different types. If you're in a flood zone, you'd have flood insurance. And then you have private mortgage insurance, otherwise known as PMI, if you're not putting down 20%. So all of those kind of go into your mortgage payment. And then if you have an HOA, that payment can also be in there as well. But it doesn't spell the nice little acronym called PITI that everybody talks about. So we leave HOA out. But those all can be in your mortgage payment. Oh, let's see if we have a comment. There we go. So all of those things are going to be in your mortgage payment. So if you're looking at a mortgage calculator and you're like, well, it says my payment's $1,000 and you're telling me $1,500, well, is what you're looking at including your taxes and insurance? Because if you're in Louisiana, which again, most of you that are watching this are, I don't know if y'all know this, but we had a hellacious couple of years with hurricanes and natural disasters. The insurance companies want their money back. And so premium in Louisiana, especially South Louisiana, is utterly ridiculous. It is insane, the dollar amounts that we're seeing attached to some of these premiums. If you're Alexandria and beyond, you guys are okay. Like, you still have normal insurance premium. They're higher, but they're not what we're seeing here in South Louisiana. So these things add up and they cost money. So it's really important that you understand. And one of the reasons why we're so eager to get all of your information and know exactly what property you're trying to purchase, so that we can help you secure quotes for these things, so that we can give you accurate numbers. But that's what's in your mortgage payment, all those things. And if you're not seeing those things, then you're not getting told the full story. Okay. For closing costs and prepaids, what I want to do is jump out of the PowerPoint, and I want to show you a document called a loan estimate. And you really need to understand how to read one of these if you're going to purchase a house, because this is the document that every lender is required to send to you within 3 days of you going under contract. And it's going to spell out all of the costs and fees associated with your loans. So we're going to go through that as quickly as I can. And I'm also going to show you the numbers that matter the most and kind of where the games are played. So let me pop out of here, and we're going to go into here. I hope everybody can see this. So this is a sample loan estimate. I'm not like on here showing somebody's personal info or anything like that. But you're going to see the date that it was issued. You should see your name and the address of the property you're purchasing, hopefully, and the purchase price of the loan term. You're going to see how long the loan is for, what type of loan it's a purchase, and whether it's a fixed or adjustable rate. And then it's going to be checked off what type of loan program you're getting and whether or not your rate is locked. If your rate is not locked, it doesn't really matter what rate they're promising you, it can change. And in today's market, rates change daily, sometimes hourly. So it's always important to understand that going in. If your rate's not locked, you're not guaranteed anything. So understand that going in. So going into the terms, you're going to see your loan amount, which you say, well, that's different. Yes, because this is what you're borrowing. This is what you're purchasing it for. Here's your interest rate. Ha ha ha. We're not seeing that. We haven't seen that interest rate since last year, early last year. And I don't know if we'll see that interest rate again. But good one, CFPB. And then you're going to see your monthly principal and interest. Now, please note, this is just the P&I. This is just principal and interest. This isn't taxes, insurance, and everything. That's further down. So it's going to tell you if you have a balloon payment. It's going to tell you if you have a prepayment penalty. You will never see this on a residential loan because currently, I don't even know why they have this on their sample. I just looked at this. They don't allow lenders to charge a prepayment penalty. So you'll never see yes right there. And if you do, then you're not getting a standard loan. You're getting something non-QM. All right, moving on. So you'll see your projected payments. This is the number here. Mortgage insurance and estimated escrow. Again, ha ha ha. We haven't seen escrow numbers like that in a while, at least not in South Louisiana. So it's your principal and interest plus your mortgage insurance plus your taxes and insurance. That's what your escrow is. And that would be your total payment. And then it says, hey, years 8 through 30, when the PMI falls off, if it's a conventional loan, it's $968. And again, it's going to tell you what the estimate includes. Here we see property taxes, homeowners insurance, $206 a month. Now, you want to focus on this number, and you want to focus on estimated closing costs or estimated cash to close. So what this represents is your down payment plus your closing costs. Now, a lot of times the first-time home buyers, they will freak out and they'll be like, you want me to come up with $8,000 plus $16,000? Like, no. This is the all-in number right here. It's not 8 plus 16, it's just 16. And that includes your down payment. So if you're shopping your lender, you want to focus on this number and this number, right? Theoretically, that's what you would want to do. Unfortunately, lenders play games, and we choose not to do this, even if it makes us we lose a couple deals because we don't play the game, because the client doesn't know any better, because we call that unethical where I come from. But where lenders will play games is this estimated cash to close is highly influenced by your prepaids, your initial escrow payment, your title fees and insurance fees, all of these fees. Now, what I need you to know as we go into this, as your lender, your loan officer, the only fees they control on this entire deal are the fees listed right here. And no, this is typically not their compensation. This is typically you having to pay points to get the rate you're getting, them charging you an underwriting, a processing fee, an application fee, a service fee. There could be all kind of different names for the fees that lenders put here. Just know that anything in box A is something the lender is charging you, and that's what you want to shop. You want to shop the rate up here and box A up here. Well, why don't you want me to shop estimated cash to close? Because the game that lenders play, first of all, they'll play games and they'll call it a loan fee, and it's like $2,500, but really it's points. And so they'll tell you they're not charging you points, but then we look it up and we would just say you're paying $1,800 for this in points for this, right? Because we don't charge those fees. But the reason why we can't say just focus on cash to close, in a perfect world we could. If I'm a lender in South Louisiana and I know this market, and I know that homeowners on insurance on this house is going to cost you $4,000 a year, and the call center lender in Michigan doesn't know this market, and so he just puts in $1,000 a year. Well, now his closing cost is 13 and mine's 16. And so you're going, Channing, like, I want to use you, but you're $3,000 more expensive than Michigan Man. And the issue with that is that the only fee I control, the online lender controls, your local lender, the lender your realtor refers you to, the only fees that we have any control over are the fees in box A. Every other fee in every other box, B, C, D, F, G, H, the whole alphabet, is an estimate of charges because these fees are being charged by a third party. And so if I reduce your title fees or I make your escrow payment look cheaper than it will be to win the deal, that's great. But when you're a week or two from closing and I go, James, look, I know I said it was going to cost you 13, but we didn't have your insurance quote back. And now that we got your insurance quote back, it's actually 18. And you're like, what the heck? I don't have 18. I got 14. I don't have 18. And now you're 2 weeks away or a week away or 3 days away from closing and everything's falling apart. So that's the game that online lenders play. And unfortunately, some local lenders too. And so you have to be careful when you're doing this. You have to pay attention when you're doing this, when you're going through this. Shop these fees, because if you can get the cheapest fees in box A and the cheapest rate, that's going to be the better deal. Because I don't care who your lender is, the rest of the fees are going to be what they're going to be. You're going to pick the title company you're going to use, and there is a small variance between them. Nothing ever more than $1,000 that I've seen, unless it's a crazy one. Somebody not local or something like that. The insurance on the house is going to be the insurance on the house. The taxes on the house are going to be the taxes on the house. These numbers aren't going to change. They may look different. They may be different on the form, but in real life, when you go to close, the numbers are going to be the same because the insurance company is going to charge you the same amount no matter who your lender is. The county or parish is going to charge you the same amount no matter who your lender is. So that's the game that you have to look out for if you're a first-time home buyer. Don't get got by a lender playing games with the numbers to make you think you're getting a better deal, or like, yeah, we're going to help you out. I know you only have limited funds. We're going to squeeze this in. We're going to make this work. And you're all excited and you tell all your friends, and then a week before closing, your loan gets denied because you don't have enough money. Or you gotta beg Aunt Sue for $3,000. And you really don't even like borrowing money from anybody, let alone Aunt Sue. Right? So, but that's how you kind of go through these. So that's what these are. Box A is lender fees. Box B is your services you can't shop for. Your appraisal. The lender's going to order that through a third-party company. We have no control over that. Very little control. Your credit report fee. Some of these, like the credit report fee, which has just gone up tremendously this year, doubled basically. The lender does charge these, but again, they're third-party charges that we pay for. So like it's going to cost us now in 2023, take it easy on your lender because it's going to cost your lender almost $100 to pull your credit. And we pull a lot of credit reports for people that don't close with us. So you can understand that those types of things start to add up. So you're going to see that. You're going to see title fees in here. This is the title company. Your realtor may recommend one. Your lender may recommend one. Understand that you as the buyer have the option to pick the title company. It's federal law. Now, you may not win the deal if you refuse to use the title company that they want you to use, but you do legally have the right to pick the title company. You can't be pressured into using a specific title company as the buyer. So keep that in mind. And then you have taxes and government fees, prepaids, which are your insurance up front. So you have to pay your insurance for a year up front when you close on the home. And then you also have your escrow account. And I'd love to jump into escrow account. We're already at an hour and a half, so I got to keep going. You pay the year up front so that you can cover the first year, and then you're making your payment. And then the payment that you're making covers the second year and beyond. If you didn't pay a year up front, when your taxes were due on, or when your insurance was due on year two, you'd have no money to pay it. So you're not being double charged. It's just kind of how it works. Your initial escrow, lenders will keep a cushion. So 2 to 3 months of your property taxes and insurance will sit in your escrow account each year, so that if your premium goes up, they can try not to raise your mortgage payment, because those things do fluctuate from year to year. And then you have owner's title, which is highly recommended. Usually not $1,000 though, more in the $300 to $500 range. With owner's title, it protects you against title defects if the title company messes up. If some sibling that they didn't know about comes 5 years down the road and tells you they own the house and you got to go through a legal battle. I'm not a title rep or an attorney, but typically the owner's title policy is designed to protect you from legal issues arising from defects in the title of the home. So, but yeah, so all of those numbers make up your cash to close, which theoretically is the numbers you should compare. But like I just said, you need to be careful to make sure that you're comparing apples to apples and not apples to oranges. At the end of the day, box A and your interest rate is where it's at when you're shopping lenders. All right. Let's hop back in here. So let's talk about, we're almost done. 10 minutes and we're done. So if you're on here and you're like, man, when's this guy going to shut up? 10 minutes and we're done. The number one mistake first-time home buyers make is you start shopping for homes before you get pre-approved. So listen, you know now the loan programs. You know what the lender's looking at. You know what your loan officer's job is. I didn't have enough time to go into the real estate side of things. Perhaps we'll get a realtor on here to do one with us. You know what you're looking at now. Don't make this mistake. Now, why? Why can't I go meet with a realtor and look at 3 homes without being pre-approved? Because until you're pre-approved, unless you're paying cash, and if you're paying cash, I don't know why you're watching me. Unless you're pre-approved, you have no idea that you can for sure qualify for that house. And how terrible it is to go look at a $300,000 house and then be told you can only look at $200,000 houses. Well, if you've been driving in Bentleys all day, you're not going to want to go home and get in the Accord. It's just not how it's going to work. So it keeps you in the range that you're supposed to be in so that you can see what you're realistically able to qualify for. Number 2, you can make offers. So when the market is competitive, and it's not that competitive right now, but when it's competitive, you may need to make an offer immediately. And the first thing they're going to say is, where's your pre-approval letter? And if you don't have that, and you got to go spend a day to get a pre-approval letter, and 5 other offers have come in, and you lose the house that you love, that you could have qualified for, you just weren't ready, it creates issues. But more than all of that, it gives you the ability to know what you're looking at. This is going to be the largest, single most biggest purchase of most people's lives. You do not want to go into that blindly without already having an understanding about what this house is going to cost you per month and how much it's going to cost you out of your pocket. You need to understand and know those things. And a pre-approval is what's going to do that for you. So let's talk about the pre-approval process really quickly. With us, I can't speak for other lenders. You go to the online lender in Michigan, you're not going to talk to anybody. You're going to punch some info that you think is correct but might not be into a computer system. They're going to give you a pre-approval letter. You're going to think you're good until you're not. With us and with a good lender, the first place we're going to start is a goals and options call. What is that? We're going to talk about your goals. When do you want to buy? Where do you want to buy? Why do you want to buy? How much do you think you want to spend? Okay, here's what I think your options are based on those circumstances. From there, if you're ready and your timeline is right, typically 3 months or less, unless you have credit issues, we're going to send you an online application. You're going to complete the online application. It takes 10 to 15 minutes. You're going to upload your documents. We're going to tell you what documents here in just a second. We're going to run your credit. We're going to review your documents. We will not run your credit given the increase until we have your documents, because we want to make sure you're committed to us and, serious about the process. And who wants to just go have their credit ran when they're not even sure they want to do it? Like, we're not about that life. Once we run your credit and review your documents, we're going to present your loan options to you. That's going to be a follow-up phone call, most likely, or potentially a screen share video, like kind of what we're doing here. And we're going to present those loan options, and we're going to review those loan options with you and say, hey, here's 3 options that could work. My advice is this one. What do you think? At the end of the day, it's your choice. It's your money. I'm not paying your mortgage. You are. Once we go through that and you're good, you're golden, you're ready to go, we're going to give you that pre-approval letter. We're going to say, hey, do you have a realtor? Can we call her? Right? One of the biggest pet peeves as a lender that deals with people across the state in multiple states is we know that most lenders have preferred, or most realtors have preferred lenders. But we've spent time, effort, and energy in getting you pre-approved and collecting your documents and working with you. So we want to get their information so that we can call them and let them know about us, let them know about your pre-approval, and hopefully not get poached and have your loan and have you convinced to go work with their lender that pays for all their marketing, right? We want to keep you with us. We want you to be a part of the Bayou family. So we're going to ask you for their contact information. We're going to issue you a pre-approval. We're going to call your realtor. We're going to send it to your realtor. We're going to call them. We're going to send them a text if they don't answer, like, hey, this is who we are. And then you're going to start shopping. You're going to start shopping for a house. Your realtor is going to start showing you houses. You're going to get a feel for what's out there. Generally speaking, 10 or less homes is what it usually takes. You may go to the first one and fall in love. 10 or less is generally what it takes for you to find that perfect house. But that's how the pre-approval process starts. Now, let me just say this, because my mission is to give hope to the hopeless, right? Maybe you've had past credit issues. Maybe you haven't paid your bills on time. Maybe you've been denied by other lenders. Maybe you got all kind of stuff going on. When you enter that phone call with me, there's no shame there. We're going to talk about the facts and we're going to deal with the situation at hand, but you don't ever have to be afraid of going through this pre-approval process because of what your financial situation looks like. People make mistakes. Excuse my French, but shit happens in life. So when you work with us, it's a no shame zone. We'll look at what you got going on and we'll give you advice. And it's never no. If we aren't able to do it now, it's never no. It's just maybe not right now for some. But for others, you'd be surprised on what you may qualify for or what you may be able to do. So understand that. Don't ever be afraid of the pre-approval process, at least not with us. So what documents should you prepare if you're getting ready to buy a home? I see this is duplicated. So that part of the PowerPoint is going to be useless, but I'll just tell you. So you just listen to me, don't look. 30 days, most recent pay stubs. Okay, if you're a W-2 employee. If you're not your own boss, if you're working for an employer, 30 days of W-2 most pay stubs are very critical. 2 years of W-2s, very critical. Now your W-2 is this is the document that your employer gives you at the end of the year to give to your tax person. It's not your tax return. Those are critical. In fact, most of the time, we don't even need your tax return unless you're self-employed. But we need those pay stubs. We need those W-2s to make a decision on your loan. Next, we're going to need 60 days most recent bank statements. So 60 full days, all the pages, even the one left blank. Got to have your account number, got to have your name, all that good stuff. Can't be blacked out or anything like that. Yes, we're going to see your transactions. No, we don't care. We're looking for two things: recurring payments that didn't show up on your credit report, or maybe you didn't tell us about. Like if you didn't tell us you have child support and I see child support going out once a month, or twice a week, or twice a month, or once a week, we're going to know that we need to count that in your DTI. Or maybe there's an auto payment that for some reason is not reporting. And then we're looking at cash deposits. Anything other than payroll that's more than like $500, unless it's USDA and then it's more than $100, we're going to be asking you about. We're going to need your driver's license. With those documents right there, if you are not self-employed, we generally are going to have enough to make a decision on getting you pre-approved with those documents. If you're self-employed, I can't even cover all that in this video because we're so far out of time, but we need your tax returns. We need your schedules, all schedules. And then depending on your business structure, we may need business tax returns and K-1s. And just know if you're self-employed, you and we're going to be real comfortable with each other because I'm going to get real deep into your finances if you're doing a traditional mortgage. Now, if you're doing non-QM, different story, higher rates, more down payment. But for the vast majority of you, those are the documents we're going to need to get this ball going. So if buying a house in the spring is on your list, go start getting those together, right? Go start getting those together. So Is 2023 going to be your year to buy a house? I see that quite a few of you have stuck with me throughout this thing. For that, just really quick, I want to say thank you. It means a lot. It really does. It means a lot. My goal this year is to give more than I get. And so one of the ways I know I can do that is through education. So let me ask you again, those of you that stuck with me, those of you that may see this at a later date, is 2023 going to be the year you buy a house? I can help you if that's what you want to do. So all you have to do, here's your next step. Here's the first step of your game plan. If you go to some call it hyphen mortgage, bayou-mortgage.com/my name, Channing Moore, it's on the screen. That's going to take you to a web page. Okay. I'm going to show you what it looks like. That's going to take you to this web page where you can book a call with me. When you get on this call, you're going to go in here, you're going to book whatever time, you're going to give me your phone number and some information, right? And you're going to schedule the event. This is going to be a 15 to 30-minute phone call with no pressure. I'm going to ask you a bunch of questions. You're going to ask me a bunch of questions, best you can think of. I'm going to recover some information with you. And if at the end of that call, you feel like you still want to move forward with the information that you were given tonight and what we discussed on that phone call, mainly that it sounds like you meet the criteria and that your timeline is where we need it to be, then we will invite you to do the online application and go through the pre-approval process. Excuse me. If at the end of the call, that's not the case, that's fine. We'll set a follow-up. Hey, I'm not ready yet. Call me in June. Great. We'll call you in June, right? And we'll go through the process again. No pressure, no obligation, 15 to 30 minutes because, I need to change that. It says 10 minutes. Y'all see me talk tonight. I can't just do 10 minutes, right? Unless it's real short. But I want to help you. I want to help you this year. So all you have to do, I'm going to put it back on the screen, is go here and you'll be ready. You'll be prepared, right? What's the worst that can happen? I'm not going to yell at you. I'm not going to shame you. I'm not going to tell you that you're crazy for calling me. We're going to have a conversation and we're going to determine if you're ready now or if we need to go into some other avenue like credit and work on your credit or work on finding you a better paying job or teach you how to do some side hustles. I got some side hustles, right? Whatever we got to do. I want to work with you. Listen, thank you so much. For those of you that stuck around to the end, man, y'all are troopers. I mean, really, give it up for yourself. I hope you're clapping in your house right now. If you're still here, can you please drop me a comment and let me know that this was good for you, or if it was terrible, just put terrible. Thank you for sticking around. I'm going to hang out here because it's a school night, but I'm going to hang out here. My kids are already in bed, so it is what it is. And if you have any questions before you book that call, I'm going to drop the link to the call in the comments. Do you have any questions? I can see the live chat. If you want me to answer a question right now, let me know. Otherwise, there's the link. I look forward to working with you. Thank you so much. Thank you, Taylor. I appreciate you being here. Thank you. I think it's Lana or Lena. Thank you. I look forward to working with you as well. So I'm going to drop this link in the comments. Thank you, Kenneth. Man, I appreciate you coming, dude. I appreciate every one of you. You guys have no idea. I truly do. It's always a risk doing something like this because you never know, no one could come. So the fact that we have this many people, I'm glad that it brought value to you. We are going to do this, by the way, twice a month, I think, at minimum once a month. So if you watch this and you have a friend, a family member, or someone that you feel like can benefit, then definitely get them connected to us so that we can get them plugged into the next one that we do either at the end of the month or towards the next month. And then if we continue to do this and they do well, we may mix in some live events as well where we're in person. Maybe I'll serve up some good Cajun food or something. So, but again, thank you, everyone. Taylor, will this be available again if you're on your page? I think so. Can you make sure, guys, if I don't, and some of you that registered on Facebook, I definitely don't. If I have your email, I will send you a copy of the recording, assuming it recorded on StreamYard. If not, I'll download it from Facebook and send you that copy. So if I don't have your email address, please make sure I have it so that I can email it out to you. And you can direct message me if you don't want to drop it in the comments. But yes, I'm going to make sure that we have this recording available. Any other questions? Let me check Facebook. All right, I'm not seeing any other questions, guys. So again, thank you. I'm going to go ahead and end the stream, and I look forward to talking to you and seeing those booked phone calls. Thanks again.